Imagine receiving dividend yields as high as 100%. Sounds incredible, right? But what if I told you that these seemingly lucrative YieldMax ETFs could drain your portfolio faster than you think? Stay tuned to uncover the hidden dangers lurking behind these high-yield promises. Welcome back, investors. Today, we're diving deep into the world of YieldMax ETFs, those enticing investment vehicles promising jaw-dropping annualized dividends. From MSTY to TSLY and beyond, these ETFs are turning heads across investment communities. But what lies beneath their shiny surface? We'll explore the top 5 reasons why YieldMax ETFs can be a risky choice for your investment portfolio, from NAV erosion to steep fees and more. If you're considering these ETFs, this is the must-watch guide to better inform your investment decisions. First, we'll unravel the concept of NAV erosion and how it affects your investment's value over time. Then we'll look at YieldMax's covered call strategy that limits your upside potential. We'll also highlight the heavy losses these ETFs can incur in volatile markets and break down their steep fees that eat into returns. Lastly, we'll discuss the complexity and tax headaches associated with these investment strategies. Stick around to learn about safer alternatives to YieldMax ETFs that align better with your financial goals. YieldMax ETFs sound incredibly appealing at first glance, boasting dividend yields of anywhere from 30% to 100% annualized. However, beneath this tempting facade are some significant risks you should be aware of before investing. One of the critical issues is NAV erosion. While it may seem logical for the net asset value, NAV, to drop when these ETFs pay distributions, it's particularly troubling with YieldMax. They pay out what is essentially a return of capital, not true dividends, which means that over time there is a significant drain on the NAV. This phenomenon is called NAV erosion. Even if the underlying stock appreciates, the ETF might not reflect that gain. For instance, Reddit users point out that TSLY's shares are down 64% since inception, while Tesla's shares have reportedly gone up by 120%. This kind of erosion is a red flag for investors who are looking for steady growth alongside income. The upside potential for YieldMax ETFs is often severely limited by their use of covered call or option spread strategies. While these methods generate income by collecting premiums, they also restrict gains during rallies of the underlying stock. Essentially, you trade the potential upside for immediate cash flow. A concise observation from Reddit summarizes this situation perfectly. You're getting cash for some of the upside and holding the downside. While this arrangement might seem attractive for income-focused investors, it means missing out on significant potential gains when markets are bullish. If the stock rallies, these ETFs will likely lag behind, unable to fully capitalize on the upward movement. Volatile markets also pose significant risks for YieldMax ETFs, as seen in 2024 when several of them significantly underperformed, losing more than 50% in value, whereas the broader market surged. Such poor performance has even led Morningstar to rate YieldMax among the worst ETF launches, citing their complex structures and substantial downside risk. Investors should be wary of jumping into these ETFs expecting consistent returns irrespective of market conditions. Given these severe losses, YieldMax ETFs might not be suitable for risk-averse investors who prioritize stability and consistent growth over high risk. A further concern is the steep fees attached to these ETFs. Typically, YieldMax funds have expense ratios around 1%, which is notably higher when compared to standard index ETFs, which can cost as little as 0.03%. Additionally, fund-of-funds like YieldMax bear nested fees, bringing the total up to approximately 1.28% annually. These fees eat into your potential returns even before any distributions come your way. For investors seeking outweighed returns with lower costs, these hefty fees could indeed be a deal-breaker. An often overlooked downside is the complexity and potential tax headaches involved in YieldMax's investment strategies. The intricate use of options makes these ETFs much more complex than traditional ones. Moreover, the significant monthly payouts, which may seem attractive initially, are taxed as ordinary income rather than qualified dividends. This can considerably affect an investor's net returns, particularly in taxable accounts. In essence, the more complicated nature and unfavorable tax implications make YieldMax ETFs less ideal for individuals seeking a straightforward investment vehicle. So, who are YieldMax ETFs truly for? Predominantly, these products target wealthy investors who are in need of a steady income and are capable of withstanding NAV losses. However, for the average individual investor, especially those saving for growth, the trade-offs are too substantial. The high yields aren't equivalent to a smart investment when weighed against the downsides: NAV erosion, capped upside, steep fees, and complex tax treatments. If you're looking for income-focused investing, alternatives such as dividend-focused ETFs like SEHD or VYM, which do not suffer from these significant pitfalls, or even adopting a strategy of buying and holding growth stocks while selling calls yourself, may offer more control over your strategy and taxes. Considering all this, YieldMax might look like a golden ticket, but the inherent risks of long-term capital erosion, performance lag, and high costs are too considerable for most investors, especially beginners. Safer and smarter ways exist to build income and wealth without overexposing yourself to unnecessary risks. In summary, while YieldMax ETFs promise high dividends, they come with significant downsides. NAV erosion steadily devalues your investment, and the covered call strategy prevents any substantial gains in bull markets. High fees and complex tax implications further diminish returns. For most investors, particularly those seeking growth or building their portfolios, these ETFs may not be the best choice. Instead, consider alternatives like dividend-focused ETFs or crafting your own strategy with growth stocks to maintain greater control and mitigate risks. Are you still tempted by the alluring yields of YieldMax ETFs, or do the risks outweigh the rewards for you? Let us know in the comments below, and don't forget to subscribe for more insights on navigating the complex world of investments. If you're seeking safer alternatives, I'm here to help guide you on smarter paths to wealth building. What investment topics would you like us to cover next? Share your thoughts.